Today, Mr. Chaudhri is going to make a very interesting presentation for us. Thank you very much for accepting our invitation, Mr. Chaudhri. The floor is yours.
Thank you, Dr. Bahar, for that very kind introduction. It's an honor and pleasure to be invited to speak at OSTİM. Dr. Yulik is a long-term friend of mine, so I'm glad I've been involved with the university from the beginning to see it grow to such an extent. And I do also want to thank the board of directors, the professors, as well as the students for taking their time to listen to me. If possible, can we share the presentation onto page number 3?
Paylaş. No. Is it okay now? Ben kendim.
Yes. No, thank you so much for sharing that. If we
Okay.
could just go down to page number 3, I do apologize for the small text, but the presentation should be available to the students afterwards.
Okay, I can share your presentations with the students.
Yes, if we could start at page number 3.
Okay. Number 3, just a second. This page, number 3?
Yes.
No.
So there's a lot of verbiage here, but maybe I'll discuss it orally. What is our conclusion and our objective? The discussion today will be about opportunities and risks in a multipolar world. So the world in the 1970s and 80s was bipolar between the United States and the Soviet Union bloc. And after the fall of the Berlin Wall, became more of a unipolar, where the United States was the key global superpower. Over the past 3 decades, China has risen at an extent that's almost unprecedented in history. So we're now in a multipolar world with many different constituents and areas around the world. Our objective today is to see the world from the light of what are the dependencies around these different poles, where are the opportunities for investment, and where are the risks. So I apologize for that dense overview in the beginning, but we will be covering all the conclusions throughout the portfolio. So if we can move over to page number um, 12 in the presentation. So page number, yes, thank you so much. So this is a graph. Yeah, so this is a graph that goes back almost 1,000 years. And if you look at the dark maroon and the lighter yellow colors are India and China. Historically, India and China were the world's largest economies. And you can see the steep decline was due to the expansion of global colonialism emanating from Europe. These economies became highly advanced, highly value added, to basically becoming providers of commodities to European manufacturing and return purchasing of goods back from Europe. So the value added and economic proposition switched from the emerging markets to basically the Western world. Now, what has happened since liberalization, you can see that both China and India are expanding quite rapidly. And the emerging markets, which had been 75% of world GDP, fell down to below 25% by pre-World War I, are now back up to 50%. So the long cycle supports the emerging markets in terms of GDP growth rates, population growth rates, with young populations, more productivity. So hence the long cycle supports emerging markets. If we turn the page to page number 13, this shows the great standing of empires. It comes from Ray Dalio's book, which has a lot of data and is worthwhile reading. The blue line on top is the United States. What's fascinating right now, never in human history has an economy been so dominant on the world as the United States. Now we see that red line coming up. We can also see that never before in history has an economy risen so fast as China. So the two massive economic empires right now are the United States and China. Now, there's many people who propose that it's the end of the American Empire or the end of the Chinese Empire. I strongly disagree with those propositions. Both these two economic superpowers also are leaders in technology. So if you look at AI patents and global patents, the majority are generated by the United States and China. And with the acceleration of AI accelerating at an accelerating pace, both these two nations have a significant lead that'll be difficult for other countries to catch up with. Now, the conflict between the two nations, or the perceived conflict between these two nations, is obvious that the empire on top resists the rising empire, which is China. So these economic tensions will remain, but the conclusion that we will come to, or I will try to persuade you, is that these two countries are highly interdependent and that there will be more cooperation than competition, but the competition will inevitably remain. So if we turn the page over just to page number 14.
14.
Yeah, so this is the evolution of China. So you can see that China was completely devastated by the colonial experiment. But since 1978, which is liberalization, you can see at the bottom, China as a percent of the world economy went from a very small percentage to a significant percentage now being the largest. It has grown by 25 times. So the 2,500% growth in China is spectacular. If we look at life expectancy, it's gained significantly. Social indicators have gained significantly. Infant mortality. So the Chinese miracle is almost unprecedented, and there are many reasons for it. We can't go into it in this presentation, but the ascent of China has been more rapid than any country that we've seen over the past 1,000 years. Now, if we turn over to the next page, page number 15, you can see by 2050, the majority of countries in the top 10 will now become emerging markets. So this echoes the previous chart that we showed about the rise of emerging markets. Now, if we can, perhaps we can turn to page number 17. The world, regardless of these trade wars, regardless of the tariff wars, is extraordinarily an independent world. I think we might need to scroll down. We're between two pages.
Yeah, I know. I don't think.
Yeah, thank you. Perfect.
Yeah.
So you can see that North America is a huge importer of electronics and commodities. If you look at Europe, it's similar in terms of being a net importer of basic goods, commodities, and energy. So Europe is highly dependent on many areas, including energy and commodities. If you look at China, China itself is highly dependent around the world for food and energy. In terms of exports, these countries are highly export based. But looking over at the next page, on page number 18, the dark blue line indicates this is manufacturing resources in different areas, from electronics, textiles and operations. You can see China is extraordinarily dominant from a global perspective. So cutting off China for any economy will be very difficult because they produce goods at a very low price, and any tariffs put on China become inflationary to the economy, putting those on. If you look at mining is very strong in Latin America. The thesis we'll come out to is that one of the greatest opportunities for the next decade will be the ASEAN region, Southeast Asia, and Latin America, because both the two superpoles, China and the United States, do require these two regions. Now, if we turn over to the next page, number 19, which is the global supply chain. So this goes across many areas of technology, semiconductors, uh, uh, in terms of areas of renewable energy, electric vehicles, battery storage. The red dot represents China. In 75 to 80% of the world's most critical industries, China has massive market share. So again, China is a supply chain of both manufactured goods, but also high technology. It's evolved from a basic producer to a country that actually is very technologically advanced. In some ways, more advanced than the United States, and in some areas, the United States is more advanced than China. So the Chinese effect on the global economy, including the United States, is deep. And the two countries, although we hear a lot on the trade war, will not have a divorce, and we will discuss how they will resolve their trade issues. If we do go over to page number 21, in the past, trade had been goods, it had been services, but now increasingly trade is data, it's intellectual property. So the trade of the future, especially for this generation of students, is going to be very different from the previous generations, whereas mainly goods and services. Now trade will be based on data and intellectual property. So again, here, China and the United States are highly dominant in this particular future industry. And so I constantly say that both these two superpowers will remain in power economically relative to other nations and will continue to gain their power going forward. If we do look at perhaps page number, we can jump to page number, maybe just page number 24. So on page number 24, I do want to point out is that as our own allocations, we do see a lot of merit in having hard assets. So this is the price of gold priced in different currencies. And you can see that different currencies have debased against gold significantly over the past 400 years, and even over the past 50 years. So hard assets, due to the monetary policy of money printing, hard assets remains a very interesting place and exposure we think that we should be exposed to within our portfolios, but also we think broadly as an asset class unto itself that will become very important. It is important and should become very important. We turn the page over to page number 26. Now on page number 26, when we look at this chart, on the left-hand side is valuation, which we call price to book. On the right-hand side is profitability as measured by ROE, return on equity. So what one wants to do as an investor is buy cheap assets that produce good returns. That's the essence of value investing, which we do. So you can see right now, the United States and India are perhaps above the regression line, which indicates that per unit of ROE, although these are extraordinarily productive economies and companies, they're generally more fully valued. If you look at the emerging markets, whether it's Brazil, UAE, the Philippines, South Africa, Turkey, China, we can see that they actually are quite cheap and one gets good returns. So in general, we remain overweight emerging markets and see incredible opportunities from a value perspective. If we change the page over to page number 27, this is the emergence of the global South. So as the trade tensions have accelerated, in many ways, China and the emerging market bloc is becoming more unified. They're trading more amongst each other. They will have currency regimes amongst each other. So the emergence of global South, if we compare that to our earlier view 400 years ago, where emerging markets dominate the world economy, that is beginning to play out as well. So, excuse me. So the emerging markets remain something that are powerful and growing at a very rapid pace. So if we turn the page over to page number 28, this is the Chinese stock market, and this is measured on the left-hand side to something called the PE, which is the price to earnings ratio. And we can see that the Chinese market is among the cheapest markets in the world. And so incredibly, as the US and China dominate the world of technology, we can get highly dominant companies in EVs and technology at a very cheap price right now in the emerging markets and specifically in China. Yes, there are several issues of China. In particular, on the next page is page number 29, which is the property bubble. You can see that although the yellow line is Japan, the blue line is China. You can see that although there was a bubble in China, it was not as large as the Japanese bubble previously. And the country is going through significant restructuring over the past 5 years. And we think many of the bad loans are probably midway through being resolved. So that is the negative view that people have in China, but China has been quietly resolving that with their banking system being restructured. Page number 31. If we look at page number 31, we can see that the US consumer on the upper left-hand side in blue is the largest in the world. But now the Chinese consumer is gaining, and on a purchasing power parity, it is actually among the world's largest. India is behind on the right-hand side, but has amazing growth as India and China's populations are the world's largest. But if we do look at the bottom left-hand corner, in certain categories, China is extraordinary. It's the largest consumer of children's products, of spirits, of sports. Actually, China is one of the largest sports markets, even of U.S. teams. So when it comes to this perspective, China initially as an economy was more manufacturing oriented, remains critical to manufacturing. However, the consumer and policies for the consumer are rising, and China is becoming a consumption powerhouse soon, similar to the United States. So I think ignoring China from an investment perspective is probably not the wisest thing to do. If you look at page number 32, although India is a more highly valued market, the economy has extraordinary drivers behind it. On the left-hand side is the income pyramid, and then by 2030, just over a 10-year period from 2021, you can see the middle class is expanding massively. And if we look over on the next page, on page number 33, India, although is manufacturing, is still at the low end. It's surprising that India does not have significant amounts of semiconductor production for economy of its size and economy with its tech orientation. So India will be a beneficiary in terms of getting tech investment. And we just saw that Apple announced that it is opening major manufacturing. Other companies have announced major manufacturing in India. So India is a story of both consumption and FDI and investment. If we do look at the next page on Korea, we think is a very interesting market, very cheap. The Koreans are looking at Japan, and Japan has restructured and has been one of the best stock markets in the world. The Korean market is very cheap, although it's very concentrated because of its chaebol system. But here, the Koreans are among the world's largest producers of semiconductors. For memory and these areas, it is the world's largest. For EVs and battery technology, it's among the top 3 with China and Japan. So it's a country that is a technological leader whose largest trade partners, interestingly enough, are China and the United States. So we look at Korea and see incredible opportunities. Now, coming over to the next page, number 35, one of the most fascinating areas to invest in is the ASEAN region. On the upper left-hand corner, we can see the PE, the price to earnings valuation ratio, is close to an all-time low. On the right-hand side, we can see that this incredibly big market of close to 700 million people is among the fastest growing in the world. So it's like almost in India, but it's below the radar screen. Additionally, there is a huge manufacturing powerhouse. Vietnam is actually the 5th largest exporter to the United States. Malaysia, Indonesia produce significant amounts of commodities and are needed by both China and the United States. So the 2 superpoles, China and the United States, need the ASEAN region, and the ASEAN region is cheap, and we find significant opportunities within this region as well. So the area that I do want to also discuss is on perhaps page number 38, which is Latin America. So again, here, if you look at Latin America, the valuations are close to an all-time low. Interest rates are high. The banking system is underpenetrated, and Latin America is a powerhouse when it comes to commodities. If we just turn the page over to page number 39, I wish to emphasize 2 nations. It is Chile and Peru, and we can see that in terms of commodities, Chile and Peru produce more copper than OPEC produces of oil. We are strong believers that the future is electrons versus petrochemicals for energy and transport. As we go towards EVs, as we go towards renewable energy, electrons will be the place to be, and the grid and electrons need copper to transport those. So emerging markets, particularly Latin America, is needed by both the superpoles, by Europe, Africa, the Middle East. Everyone needs these particular minerals. And you can see on the right-hand side, these stock markets, again, are quite cheap and haven't priced in this long-term trend. Just a few quick areas I'll point out to. There's quite a bit of information, but if we could, maybe let's jump to page number 43. So our belief is that we have passed the peak oil demand era. And part of that is that the list price of electric vehicles has now reached the same as an internal combustion engine. So EVs are the same as the ICE in terms of list price. The total cost of ownership of an EV and ICE, EVs are cheaper because they use electricity instead of oil, and they have less moving parts, which makes the maintenance lower. So we think that oil demand is peaking. So countries that export energy are actually going to have differential terms of trade. Countries that import energy like Turkey or other emerging markets will actually benefit because the price of petroleum is now, we think, has peaked and will continue to be in a secular decline. So this is a benefit to Turkey. If we go over to page number 45, these are many of the commodities that we are exposed to invested in, and they are green energy related: aluminum, copper, nickel, manganese, cobalt, lithium. You can see that there is a significant amount, if you look on the right-hand side, of a deficit in these critical green energy minerals, in particular base metals and rare earth. So these are required for the future economy, and these are areas where we just don't have enough of, and these are areas where our portfolios do have some significant overlap. If we do go over to page number 47, you hear a lot about rare earths. Rare earths are actually not as rare as you think they are. They're common throughout the world, But again, the mining process will take some time to extract them and to benefit from them. And the last thing I do wish to point out is page number 49. If we look at page number 49 is green hydrogen. This is a nascent technology, but it's a technology that renewable energy will use so that we can produce, basically, it's distilling the hydrogen from water, and that is a energy intensive process. And we'll be using renewable energy to produce fully recyclable hydrogen. And this is a trend that'll manifest itself over the next decade. And I believe that Turkey has many projects involved in green hydrogen as well. So just a few last questions I'll have, or areas I just wanted to explore is page number 52. So if you just look at the adoption of AI and computer technology, if you look at the left-hand corner, you can see it's exponential going vertically straight up. And if you look at the right-hand side, if you look at ChatGPT, for it to reach 100 million users, it took 2 months versus, let's say, the World Wide Web took 7 years. So AI is coming. It's the new industrial revolution. It is mainly centered in terms of production of its technology in the United States and China, but it's proliferating throughout the world. So AI is a massive game changer. For the first decade, it will enhance human productivity, but then beyond that, it could start to displace human jobs as well, especially white-collar jobs. And this makes it even more difficult for young people if they look at their careers for the next 15 to 20 years. But AI is here, and it will be at a pace that eclipses the Industrial Revolution. Just one quick thing about AI is if you look at page number 55, it requires, again, a significant amount of energy. The energy is for the servers, but also servers generate a lot of heat. That heat requires a lot of HVAC or air conditioning and cooling equipment. So there's a significant amount of opportunity for us in the electrification area, in HVAC, in production of data centers, and all this again requires copper and base metals that we had earlier on. So we think a secular exposure towards commodities that serve the future trends is very important. I'll stop there. I do wish to address the trade war because it is topical too. And what is the end objective of the U.S. government and President Trump? What the president is attempting to do is reduce the twin deficits. This is the trade import deficit and the budget deficit. And that's why he wishes to do trade deals with countries. Now, the trade deals eventually what the United States can export is LNG. It is the largest energy producer in the world. We actually produce more energy than Saudi Arabia in terms of oil. Second is agricultural products. Third is technology and IP. Fourth is financial services. And the fifth would be intangibles like media and other areas where we're very strong in. So you're going to see a series of announcements to normalize trade. So the trade war will end with a trade peace over the next 6 to 9 months. So this will resolve itself because of trade normalization efforts. So I'll stop there and leave the floor open for questions.
Thank you so much. It was really very detailed and very informative presentation, and it covers a lot of topics. Do you have any questions, my colleagues? Any questions? If no, I have a question. Is it okay?
Yes, please, Doctor.
As you said, the US make some changes in tariffs to other countries. So what do you expect this tariff will affect the world economy in the future coming years?
Yeah, I believe the tariffs are a tool to get to trade normalization to reduce the deficits. The tariffs as they are stagflationary. Inflation expectations in the US are the highest since 1981. Consumer
Yes.
confidence is collapsing, and this is a stagflationary recession. So if they stay as is, it'll be perhaps amongst the worst recessions we've experienced, except in the 1970s. And that's why there's a strong motivation to have trade deals done before the economic damage is too much. But the economic damage is already happening, and the world will go, or probably already is, in a recession. GDP in the United States for the first quarter was negative, and recession is defined as two consecutive back-to-back negative GDP. So it is very negative on the world. I think the United States, we realize this. We have midterm elections next year. A bad economy will result in a loss in the incumbent party. So the United States is very motivated to have these trade deals done. China in particular also is very motivated, as are all other countries. So the motivation is to have the trade deals done and to remove the most onerous parts of these tariffs. But the damage to the world economy is already done right now and is being done at the moment.
Thank you so much. Thank you so much. Any other questions?
John, can you hear
Yes.
me? Okay. Can I ask some questions?
Yes, please. Thank you.
Okay, thank you. Thank you for the very informative presentation and very detailed. My question is related to long-term growth prospect of China. It seems some people, some scholars believe that the long-term prospect of Chinese growth is not so brilliant, because they mention questions of population, demographic transition, productivity growth that doesn't seem to grow fast enough in China. It seems Chinese growth so far has been a investment-led growth, and we know that investment-led growth will tend to reach the diminishing return level. So it seems they point out that China is going toward a Japanization, becoming another Japan. So how can China deal with these issues? It seems to be
Yes, if we
kind
can
of
go
difficult.
back to, thank you. That's a very important question, actually. If we can go back to page number 31, if possible, on the slide screen. So there's two different areas for China. Yes, the population is peaking. Now the population is peaking everywhere, even in the U.S. without immigration. And we are going almost towards a reverse immigration policy. Our working age population has peaked. This is similar to Europe. The areas where the working age population is growing is the ASEAN region, Middle East, Africa, and Latin America. Again, it's in the global South, which supports the global South. I believe the Chinese government is well aware of their macro situation, and they've already experimented with Hainan Island to make that almost like a UAE, where you can get a permanent residency card. It's a large province that's almost the size of Taiwan off the coast of Vietnam. They're experimenting with immigration into their country with the Hainan Island, number one. Number two, the Chinese consumer is incredibly large. They have a very strong balance sheet, much better than the Western consumer. They have firepower, and the government will focus on policies that increase consumption. The third factor is that if you go into Xi'an, Chengdu, Wuhan, the labor cost there is half that in Shanghai or Beijing or Shenzhen. So there is a significant amount of now shift into the internal part of China. So that is a lot of investment, but also that unleashes a lot of very cheap labor. And the fourth factor is that Chinese technology, along with US technology, is unparalleled in the world. These two countries are technological leaders, and they'll be the leaders in implementing these technologies to increase their total factor productivity. So compared to other procrastinators and predictors, I'm not as negative on China. But in any case, the Chinese stock market is among the cheapest in the world, and we can get global tech companies there trading at 25% of the valuation of their peers in the United States. So a lot of that bad news is already in the price of the asset.
Okay, thank you very much for your responses. It seems good factors that we have to take into consideration, I guess.
When
Thank you
when the
very
news is the most negative, usually the prices are the cheapest. So we as global value managers tend to come into areas where the news might be a bit negative. And you also have a lot of negative news on the United States, but we're seeing, as the US market has corrected, significant opportunities back in the United States. So we tend to do almost the inverse of what you're reading in the newspaper.
Yes. Also, you mentioned the wage. It seems China wage is rising, but you mentioned that maybe they are moving toward the interior of China. It seems maybe if they have untapped cheap labor there. But also we see that many companies are moving toward Vietnam, Indonesia, Malaysia. These countries, they are ready to maybe to take advantage of the deindustrialization of China as they become expensive. I don't know.
Yep.
Is this also a factor?
Yes, and many of the investments in Vietnam and Mexico are actually Chinese companies taking advantage of cheap labor. But the labor I'm talking about in the interior of China is educated labor. It's like software engineers, it's people, computer scientists, it's life scientists. So the scientists and the intellectual labor in China is almost 50% cheaper in the interior than it is on the coast. Basic manufacturing, yes, many of the Chinese companies have already moved into Vietnam, Indonesia, Thailand, and Mexico.
Thank you very much.
Thank you.
Thank you very much. Any other questions? So we can continue your presentation if there is no other questions, Mr. Chaudhri.
Well, that was the end of my presentation. I do want to thank you very much for the opportunity to speak, and I look forward to coming in person and speaking with Dr. Yulik and Dr. Bahar, where perhaps we can have a lot more interaction, and very much available. If anyone wishes to email me with any questions, always available. It's an honor and pleasure to have presented here. Thank you so much.
We also thank you so much. It was very informative and very detailed presentation. I am going to share your presentation with our economics department students. I think they will also help a lot from your presentation. Thank you so much.
Thank you. Have a nice afternoon.
You too. Thank you. Bye-bye.
Bye-bye.
Bye-bye.